Good afternoon and happy casual Friday. Well, at least I'm casual. And
This
welcome to the latest edition of the Jack and Bill Show.
feel like a sharp dressed man.
Yes. So we've had started off the morning trying to get into the office on time, and I exceeded the speed limit on I-49 for a few miles. And then we had some storms roll through. And then the first storm started at 7:30 Central with uh, the release of the consumer price index numbers. Um, I should I could say that probably for the last about 8 or 9 or 10 trading sessions, we've just gone sideways, and it looked to me like the market was really kind of seeking an answer to which way we were going to go. Okay, like are we emerging Nasdaq markets in a bear market, S&P and Dow not so much. But where do we go from here? Because we're not far from being kind of normal or making money, and we're not far from being in a bear market. So one of the investment banks came out late yesterday with a guess that the consumer price index was going to be worse than analyst expectations of a year over year increase of 8.2%. And so the S&P 500, Bill, we had this volatility in the last hour, and the market fell about 2%. So that took the S&P 500 down to about 15% year to date. And then the number came out this morning, and the investment bank that made the guesstimate yesterday afternoon indeed turned out to be correct. And so selling pressure accelerated into the close today with the NASDAQ market down 3.5% all across the board. Dow down 880 points, call it 2.73%. S&P 500 falling 2.9%. So that's got us down now year to date in the high 17% range on a total return basis. Safe havens like precious metals were up today, with the yellow metal up $23 an ounce at around 1875. I want to say 1874.9, up 1.19%. Crude West Texas Intermediate down 17 cents, settling in at around 120. And this is what's alarming with the whole thing to me. And so we want to talk about this today because this is very important. This is why, I'm sure you would agree, Bill, that the markets are down this year because coming out of the pandemic, we had all this fiscal and monetary stimulus. I would argue too much from both fronts. And the April CPI print in March of last year, for March of last year, was 2.6%. And then the next month it jumped to 4.2. And that's when we started having all this talk from the Federal Reserve and Treasury Secretary Janet Yellen that this was going to be contained. It was supply chain disruptions. And the number went from 4.2 to 5 to 5.4 to 6.2 in November. And it has increased every month since. And if that doesn't get somebody's attention, 6.2 to 6.8 to 7 to 7.5 to 7.9 to 8.3 to 8.6. Most noteworthy in this print today was that the CPI increased 1% month over month, which would be annualized at 12%. And we've got the wholesale price index numbers coming out Tuesday. And the last print on that was 11.0. So there's some of the analysts that we follow say that if you want to have a good picture of where inflation is as the American or world consumer feels it, you take the arithmetic average of of the CPI, call it 8.6, the last PPI was 11 or 19.6, would be 9.8%. So we're running like 10% inflation right now. And Bill, what do you make of all this?
I concur.
You concur. Okay, you concur. Okay, so the $64,000 question is where do we go from here?
That's what's important.
Yeah, and we are. I'm going to tell you one thing that this confirms for us is that the Federal Reserve is meeting next week, and they're going to tighten 50 basis points, and they're going to tighten in July 50 basis points.
Maybe it may be more.
It could be. It could be.
Could be
more.
75 basis points. Could be a
But-
full percentage point after this CPI number.
You know, I read this morning too that the European Central Bank is now forecasting 6.8% inflation for this year for Western Europe. So, and their plans are only to tighten, you know, 0.25% at a pop, which brings us to how did we get here? And I think we had, you know, we were doing the monetary stimulus. We did 176 billion in quantitative easing in March, while the Federal Reserve is talking about stopping that and doing quantitative tightening. So they haven't been serious about this inflation problem.
Well, and they really haven't had to. And, you know, we've talked about this in recent episodes about the role of the Fed and inflation. We've seen the Fed very active in the market since the credit crisis. And with all of the quantitative easing, 0% interest rates that they've held down, you know, for as long as they did, we never got inflation. And the Fed was doing everything they could to try to achieve a 2% CPI number to no avail. And now we suddenly have inflation. So what has changed? It's not monetary policy. It's, well, the shutting down of the economy, the reopening of the economy, and the direct fiscal stimulus in the form of free money from Congress. And that's not something that the administration wants to talk about.
I'd like to throw out a little different twist that I think that we could see manifesting in developed economies in the months ahead. Take a look at Argentina. Recently reported inflation running year over year. Their April inflation year over year. Do you know what the number was?
No.
58%. And there are countries in Europe running inflationary numbers that high. But you know what's interesting about that is Argentina increased their monetary base year over year through April 43%. And I actually think that the money printing that we've done since the subprime crisis has played a monumental role in these inflation numbers that we're seeing. That's actually going to continue, and it wouldn't surprise me. I started to say worsen. If the numbers worsen from here, we're in deep trouble. So,
well, you mentioned the month over month, 1%. I think that at this juncture, the month over month numbers are more important than the year over year. And as we move forward in time, the starting point, the starting index value that we use to calculate year over year is going higher and higher and higher. So the price levels can stay where they are, and over time the CPI year over year will decline just because the starting index value is escalating as we look at that calculation.
What makes you think the index values are going to decline? Because
no, I'm just saying that year over year, when we calculate the percentage CPI number, because we're doing a look back to a starting point a year prior, as we move forward in time, that index value goes up, up, up. So the calculation will come down, everything else being equal. That's why I'm saying that the month over month really is more important at this juncture. And that month over month print of 1% is big, especially, given where we are now.
Yeah, and I think they started the with a base of 100 in 1984, and it really hadn't gotten out of control until May of last year,
Correct.
and it's
I mean,
now
this number, these inflation numbers are at 40-year highs.
yeah.
40-year highs.
So the thing, but I would say, I mean, inflation is a general rise in prices, and I mean, another way you could look at it, or if you look at like the index, if you think of where the index value is right now for the CPI, where is this thing? Where's it going to be 12 months from now? Where's it going to be 3 months from now? And I see some things. I mean, I believe it's very possible that we're in the Goldman Sachs commodity super cycle that they're talking about. It looks to me, I mean, I see strong evidence that energy prices are likely going higher. That's the biggest part of the commodity index, which is up over 30% year to date and was up over 20% last year. If you think about that, I mean, I would hate to be someone in Germany or Poland getting my gas for my house from Russia, and there's going to be supply constraints greater and greater there with Western production pulling out of there. And then I look at this political divide in the U.S. between the White House policy decision makers and the policies of corporate boards with the integrated oils and E&P companies, for example, where they don't want to increase production. They want they want the value of their stock options to go up, and the best way to do that is by buying back stock, increasing the dividend, and holding capex steady or even reducing it. And so that's what I think most of the production, a lot of the increase in production that we might see domestically is from small, independent oil producers. But we've got problems with other commodities. The other thing with energy is we're entering into the summer driving season where people like to vacation. And are you driving anywhere next week,
I
Bill?
am.
Yeah. Okay. Or fly places. So it's getting difficult to afford airfares for a lot of Americans. But we've had droughts in various places. We've got a wheat and corn shortages that are really exaggerated by the war in Ukraine and Russia's exports to Western nation. And then here's what bothers me the most, Bill, which means anyway, two-thirds of all inflation comes from unit labor cost increases, and in most of the developed world right now, there are 2 jobs available for every person that's looking for work. Now, that's the state of the American economy right now. So what that means is we've had for the last year, we've had wage price inflation of around 6%. So wages have not kept up with the inflation either. But if a company desires to hire somebody right now, because there's not enough labor out there, they've got to pay up for it. And I think part of this really as well comes from long-term demographics where Asians and Europeans and the United States has aging populations with a lot of people turning age 60 or 65 and older and deciding at a much more dramatic pace since the pandemic hit to just stop working. So those people are not, part of the labor force anymore.
Well, some of the inflationary pressures, can resolve themselves over time. I mean, certainly what's going on in Ukraine, if we were to see a ceasefire, we would expect to see commodity prices to come down. If we go into recession, and by the way, and that's, we can spend some time talking about that too, but if we go into recession, we would expect that to have a disinflationary impact. So, this stuff can resolve itself, but I think a more important question, apart from trying to forecast all this, because not even the economists, the pros who do this for a living, have been very accurate thus far. But I think for our viewers, they really want to know, well, how do you position for this? What do we do differently, if anything at all? We've had a lot of volatility in the markets. We've seen the S&P 500 have down weeks 9 of the last 10. Dow's been down 10 of the last 11. And we've been in the midst of this rising inflation environment. And I think for a lot of people, they're scratching their heads because the traditional inflation hedging playbook has not been so effective. All right, so if we look at what's happened over the last year, Jack, we've seen inflation increase 8.6% over the last year. Well, over that same time period, gold is down 3%. The S&P 500 is down 4%. We've seen the bond market really respond, which is expected, down 10%. Bitcoin, one of the selling features of Bitcoin had always been that it was an inflation hedge. Over the last year, it's down 10% over that same time period. So, as I said, people are scratching their heads wondering, well, what do we do? And it's not so clear cut. And there's a lot of nuances to this. And the fact that we are in an environment where we are reopening after lockdowns, and at the same time, we're late cycle in the economy, it makes it very confusing.
Yeah, I can tell you, especially from this report, just looking at the reaction in the marketplace, today, and this is something that I feel is likely going to continue. I'll throw this out. This is kind of a radical statement, but I felt this way for more than a year now. Or I would say since March of 2021. There has developed an ever increasing disconnect between long dated treasuries, you could even say mortgage rates, and CPI inflation, where historically, a person that buys a long dated treasury, for example, in all of the bond market trades off of treasuries. It starts there because that's the gold standard. Those are going to yield less because investors demand higher returns in the credit markets for things that become less credit worthy than a U.S. Treasury. But historically, if you go back to 1926 or you go back to 1968, you've gotten historically either anywhere from 2.1 to 3.3% more on your treasuries than where CPI inflation is right now. So if that were the case today, CPI inflation just came in at 8.6. That would put treasury yields over 10%. So there's two things at play here. Either the bond market, or call it the people that buy bonds, the countries, corporation, individuals, trust funds that buy U.S. Treasury securities, either believe that the Fed is going to get control of this inflation problem, perhaps maybe that based on history, there's a 73% probability that they go too far. Mm-hmm. We have a hard landing and we go into recession, and then that would put downward pressure on Treasury prices. Or this is my base case theory.
Downward pressure on yields.
Yes, that would put downward pressure on yields. What did I say?
Prices.
On prices. So my base case scenario is that bond yields are as low as they are because the markets have been radically manipulated. I mean, if you look even in like Japan, the Japanese central bank owns something like 45% of their treasury bonds. And here in America, we have a $9 trillion balance sheet with, what, 30 trillion dollars in U.S. Treasuries outstanding. I actually believe that we're going to see the long end of the U.S. Treasury curve normalize. And by normalize, I mean that we're going to see that relationship between being compensated for inflation realized through, higher bond yields. So here's the thing that I would say to.
Well, let me just jump in here. Maybe, I mean, that's a forecast. We don't know, but here's what's going on right now: is the yield curve for Treasuries continues to flatten, and right now, the yield curve is inverted between the 5-year and the 30-year. That means you're getting a higher yield on a 5-year Treasury bond than you are a 30-year Treasury bond. Now, when the yield curve inverts, that's something that we have to pay attention to, because historically, yield curve inversion indicates recession risk. So again, as I said earlier, there's a lot of things, a lot of undercurrents going on here, but the bond market, sure, the bond market's manipulated, but the bond market seems to be more concerned about recession risk than anything else right now.
Yeah, I mean, the bond market is really trading the way that it has historically speaking. I mean, we've had much of our economic history where the bond market has inverted, typically when the Fed starts aggressively tightening. But I would make the case and argue that the bond market has never in history been this mispriced. Okay, when we had CPI and inflation north of 10% in 2000, the bond market actually reflected that. They didn't do things like quantitative easing. Yep. And in fact, normally the markets move before the commodity, or the bond markets move before, the indicators or the yields. Before the numbers, before the CPI. If the CPI number is escalating, usually the markets, are going to react in advance to that. And I'm on the other side of this. I think, and here's one of the reasons why, Bill, is I've heard just about everybody in Washington has been saying since April and May of last year that this was an aberration and would be pretty rapidly corrected once our economy opened back up.
Oh, I would expect nothing less than the party in office, because inflation is the worst thing for a political party. And that's why even as late as today, President Biden was blaming this inflation number on Putin's price hike and greedy oil companies. They cannot take responsibility for what led us into this inflationary environment, nor will they ever.
Right. But I think that the main problem with this too is that we are seeing this in long dated treasuries. I mean, I could greatly simplify this and say one of the most simplified recommendations that I could make is
avoid long dated treasuries.
Avoid long dated treasuries. And they did. Long dated treasuries made a new multi-year high yield today. And I actually believe that's going to be one of the easiest trades going forward. Now, I wouldn't recommend this for the unsophisticated, but I think there will be a lot of money made shorting long dated treasuries.
For those who trade professionally, that's one thing. For our audience and the vast majority of our clients who are long-term investors, trading on the 30-year treasury is not advisable. It's not wise. I think for most people, maintaining an appropriate asset allocation, not actively trading in the midst of a volatile market are probably two of the best pieces of advice that we could give.
Yeah, the thing, I mean, you can hedge if you have someone who's a 70-year-old retired couple that has all of their money in fixed income securities. I mean, it would be prudent to even put on hedges for some of that interest rate risk if
Or
they're
it'd
not.
be prudent to not have 100% of your investable assets in fixed income.
Oh, I agree with that too. I mean, some clients are that way though.
And that's
So
why we've been utilizing alternatives in a major way, because it is important in an environment where both stocks and bonds are pricey.
okay, what's a
to
good alternative to fixed
have alternatives in the mix, that can generate capital gains, preserve capital, keep ahead of inflation. And we've had success, using things like trend following managed futures, for example. There's a lot of strategies that people can be using and incorporate
How
in their
about in fixed
portfolio
income,
construction.
Bill?
Well, in fixed income, we've been really focused more on the short end of the curve, taking advantage of this Fed tightening by staying short. Gosh, you could buy a 2-year Treasury bond yielding 3% today. You could get a 2-year high quality corporate bond yielding 5%. So we have to be creative.
I meant alternatives to fixed income. Okay, so if you own 100% bonds,
Well,
what could you sprinkle in there?
Yeah, I mean, it depends on how you do this. There's lots of ways, to construct portfolios. If you're limiting yourself to the universe of bonds and you're a fixed income investor, well, there's a give and take. So you have to be willing to accept lower yields in exchange for lower interest rate risk, because you're taking a huge risk in your portfolio if you are stretching for yield by buying longer dated bonds. So you have to be willing to accept lower returns to offset the risk. But for someone who can think outside of the box, like for example, these alternative investments, well, we can target a volatility that's comparable to a fixed income portfolio. So we're not adding much in the way of downside risk, and offer a return potential that's higher than what we could expect going forward in bonds. So you have to think outside the box.
And these alternatives are not necessarily suitable for every client either. Anyway, I had a long-winded conversation with a very smart, affluent client this afternoon that really wants no part of that kind of stuff. And I was thinking you were going to say, here's an area where we've gone adjustable rate,
Oh yeah,
fixed income.
yeah.
Okay, or a BDC is a business development company that there's been an evolution there since the Obama administration where the regulatory element made it prohibitively difficult for commercial banks to cater to mid-market America with adjustable rate loans. That's been picked up by the Blackstones and the Apollos and smaller BDCs that we love, and we like to sift through the high quality companies, little known companies where we can get adjustable rate bonds that are paying 6 or 7% right now with senior secured with the potential for higher income in a rising rate environment.
No, I'm glad you mentioned that, because interest rate risk arises because the bond you have pays a fixed rate of interest. And so you buy a bond, it has a fixed coupon rate. You are exposed to interest rate risk if between the time you purchase and the time that bond matures, market rates go higher, and they go higher than the coupon rate of your bond. So as a result of that, the market price of your bond has to adjust and it will go down. So it looks like you've lost money on your bond. It's just that the price has to come down to cause the yield to maturity to go up to correspond to market prices. Well, if you have an adjustable rate bond, you are hedged against that. So you have a security who's with a coupon that adjusts based on a formula, underlying formula. And so that gives you that protection from rising rates.
Yeah. And I just had another thought that here's another base case that could be crazy wrong, but based upon based upon history, having watched the actions of the Federal Reserve, through Helicopter Ben and Janet Yellen and now Jerome Powell, it seems to me, watching the actions of the world central banks, namely Japan, Western Europe, and the United States, or the European Monetary Union, it seems that they talk the talk, Bill, but they don't really walk the walk.
Yeah.
Like the comments, like you're saying, there's going to be a couple of Fed governors that are going to start saying, "Hey, we need a 75 basis point hike." But back in the Volcker days, what we needed were interim meetings in between the FOMC meetings that we have every 6 weeks. So the Federal Open Market Committee is not meeting. They have an emergency meeting and hike 1%. That's what we were getting in the Volcker days.
Yeah.
And so the ECB is admitting roughly 7% inflation for this year, which will likely be higher, and they're doing 0.25% rate hikes, which means they're not
Very little.
really
Means little.
They're not serious about thwarting inflation.
But in their defense, normally high inflation corresponds with high economic growth. So an economy that's overheating, and with that, we have high inflation. And the best antidote to that is high interest rates. Well, the U.S. economy is not overheated. If anything, the U.S. economy appears to be slowing. And everyone's looking at the Fed here, but gosh, the Fed only has a limited number of tools in the toolbox. Raising the Fed funds rate, the short-term interest rate benchmark, I mean, that may have some impact, but it certainly won't do anything to address energy prices, food prices, that type of inflation, the kind of inflation that impacts everyday Americans, cannot be addressed directly by raising the Fed funds rate.
Yeah, and that so getting back to my thesis, and we'll get to what are the implications of this. I think that the central banks, you could say, have policy decisions that are founded upon hope and seemingly a lack of know-how to me. And I could see if we do start headed for a recession, based upon Fed policy since the subprime crisis, we're very likely going to see them turn from being hawkish to rapidly dovish to stopping quantitative tightening, resuming quantitative easing to a greater extent, reducing the Fed funds rate back down to nothing. And that would actually be, in my view, very inflationary, would likely make the dollar weaken. And so I think one of the other things that we have to say,
the dollar.
Yeah.
No, I just thought of this, Jack, when you mentioned the dollar. Normally when we're in periods of high inflation, we're seeing the dollar weaken. When I was talking about the historical inflation playbook, well, we've seen the U.S. dollar increasing as commodity prices are increasing, and that's something we normally don't see.
Yeah, and I think now may be a really good time to take the other side of that trade.
Maybe. I mean, but the Fed is in a box, no question. They've painted themselves in a corner, and I think they're really struggling to do something here. But I contend that it's really not going to be the Fed that's going to put this under control. It has to be fiscal policy. I believe fiscal policy is what got us into this. Fiscal policy has to get us out of this. In the
How?
well, here, when I said earlier, the president was on TV saying this was Putin's price hike. Okay, well, if Putin is in fact responsible for this, what are we doing to end the war? Okay, he's blaming greedy oil companies. Well, the fact of the matter is, Apple made more money last year than the largest U.S. oil companies combined. It's not that oil companies are being greedy. It's just that for years, the industry has been underinvested in and has actually been vilified. So you've got Wall Street and large institutional investors that have purposely pulled money out of the energy industry because it's not green.
Listen to this, Bill. Today's Wall Street Journal, data boost natural gas prices. The data is boosting natural gas prices. Look at this chart. I mean, a year ago, nat gas was at $2 and it's around $9 per million British thermal units right now. And here's what they say. U.S. natural gas inventories are nearly 15% below the 5-year average for this time of year. I'm going to tell you, with the way things are going with the war, I mean, it looks to me like this could very well continue.
Now, what can the Fed do on that? Nothing. Monetary policy won't fix that.
Oh, no. So there's your point.
Yeah.
We need to get away from the retarded, I'm sorry, my wife hates it when I use that word, fiscal policies and accusations. And this is not a political argument.
It's not.
I'm trying to represent or speak plainly
it doesn't
about
matter.
Things that
it doesn't
work.
matter what political party affiliation one has. As Americans, we should all want to see energy independence, energy security, and using what we have available to us right now. This administration instead wants to double down on green energy investment at the worst possible time. And that I think that partly explains why consumer sentiment numbers are so low. They're coming in lower than where they were during the 2008 credit crisis. Okay? We're not even in a recession, and yet consumer sentiment is that low right now.
So here's just a couple of takeaways, and we'll I think short-dated inflation protection securities there's very strong credit quality securities right there. I like that. We still like short-dated fixed income because that's where I was getting. The Fed is likely, in my view, this is my base case. They tighten until the markets can't handle it anymore. They give up on inflation, and we go back to QE.
Or they tighten until we go into recession.
True. So, but I still don't think that solves the inflation problem because there's too much commodity price inflation, and we've got unemployment lower than we've ever had it. So we've got major demographics issues. But these are the things. Here's some steps. Some of the things we love to own, core satellite holdings, core meaning indexing things. And when you say index, Bill, you don't have to just think NASDAQ, Dow, S&P 500. I mean, a lot of the ETFs that we own, you could call index products as well. But we like, since it's my view that there's a lot of pressure on long-dated interest rates to go up from here with the inflationary picture. So we like value stocks. We like performing stocks that sell at low valuations. We love things that give us inflation protection, like you mentioned, algorithm run strategies in the commodity space. These are not high risk products.
Not at all.
These are highly diversified mutual funds that have been around since the 70s, and they're really in the sweet spot right now. So we like things that provide much higher income than the market, adjustable rate securities, global securities, precious metals, natural resources. you mentioned it, BDCs before. So
We're
These are-
we're using a rifle approach as opposed to a shotgun approach. We don't just want market exposure. We want the
Correct.
correct market exposure for this investment environment that we're in.
Well, man, you've worn me out on this market stuff today.
I have.
Um,
I think we wore Wesley out.
let's change the subject. Well, we've got NCAA college baseball tournament ongoing. I walked downstairs to get some coffee and I saw Texas playing East Carolina. So the SEC has 5 teams left. LSU got knocked out by a run at Southern Miss. Southern Miss is up against, are you looking up at the bracket?
No, I tell you what I'm looking up. I think that people are more interested in this.
Tennis,
Pickleball championships.
the pickleball. Have you ever played?
No, I wish I could.
I saw some people in my neighborhood playing it the other day, and it looks fun. You don't have to move around as much as you do
Well,
in
yeah.
tennis. Do you?
It's caught on like
Do you
wildfire.
know what pickleball is, Wesley?
Are there pickles?
Yeah, you bat a pickle back and forth over a net. No.
That makes sense.
So Old Miss is taking on. Old Miss had to travel to Hattiesburg for Southern Miss, but there's 5 schools remaining in the SEC baseball tournament. We're SEC fans here in SEC country, and we've got the men competing in the finals. It's all men today in Eugene, Oregon, at the D1 NCAA Track and Field National Championships. LSU Tigers are ranked number 5 men and number 5 women, and neither one of them really have, after the first day of qualifying, a shot at winning the whole thing.
Well,
But,
we'll turn it off.
pardon?
We'll just turn it off then.
No, I'm going to be watching it. So that's our story, and we're sticking to it.
Big announcement next Friday.
We're going to have a big announcement to make next Friday on the show. A huge announcement to make next Friday. You don't want to miss it. So
We found the cure for hair loss.
For the cause.
William has come up with a new invention.
Okay. I think we should wrap it up. I think Wesley's asleep behind the camera.
See you next Friday. Oh, we're doing that.